Hello and welcome. In this lecture video, we'll be talking about liquidation of a partnership. All right. So in terms of the steps of liquidating a partnership or dissolving a partnership, it has 4 steps. First one is we sell our non-cash assets. So any office equipment, any buildings that we have, boarding facilities, we sell those, and then we record a gain or a loss. Okay. And then that gain or loss is allocated to partners based upon their income and loss ratio, which is specified in the partnership agreement. Then we pay all of our liabilities, and then any remaining cash is distributed to the partners based upon their capital balances, how much capital that they have, okay? We have a couple different situations here for partnership liquidation. The first one is there's no capital deficiency, or we have a capital deficiency, okay? So when we talk about the first situation, no capital deficiency, that means all the partners have a zero or credit balance in their capital account, okay? That means they have a zero or a credit balance in their capital account, okay? So let's look at our example. So we have Kayla, Perez, and Rashid agreed to dissolve their partnership. The only outstanding liability is an accounts payable of $20,000. Prior to dissolving their partnership, they have the balance sheet right over here. They have cash of $178, land of $40,000, so total assets of $218. They have an accounts payable of $20,000. Then they have Kayla has her capital balance is $70,000. Perez capital is $66,000, and then Rashid capital is $62,000. So liabilities plus equity is $218. All right. Step 1, as we were saying, is that the partnership is going to sell its non-cash assets and then we're going to record any losses or gains according to our income sharing agreement. Okay. So the non-cash asset that we have that we can see on this balance sheet is this land right here, $40,000. And let's assume, as we see on the next page, that the partnership agrees to sell the land for $46,000. That gives us a gain of $6,000. So this is going to give us $46,000 cash. So we know in terms of our journal entry, we're going to debit $46,000 cash. Okay. And then we're going to credit land, because land has that $40,000 in land is a normal debit balance because it's an asset. So to remove it, just like what we talked about back in chapter 10, right, we're going to credit the asset. So in this case, we credit land for $40,000. Notice that there's no accumulated depreciation here because land is not depreciated. So then the book value of the land is $40,000, which is the cost. We sold it for $46,000 cash. That means we have a gain of $6,000. How do we distribute this gain? According to their income sharing and loss agreement, which would be specified in their partnership agreement. So let's say that their partnership agreement, let's just assume that we share our income and losses equally. Okay, so let's assume equal sharing of income and losses. So we have a $6,000 gain. We have 3 partners. That means each partner gets an increase in their capital balance of $2,000. Okay, so I say K Zahn capital $2,000, H Perez capital $2,000, T Rashid capital $2,000. Okay, and that's our journal entry. So that's step 1, is to sell our non-cash assets. Step 2, we pay our liabilities. Now you can see if you go back to the prior page, you can see that the only liability that we have is an accounts payable worth $20,000. So we pay that. So debit AP, accounts payable, $20,000, and then credit to cash $20,000. Okay? So then we come down here and we say, step 3, allocate the remaining balance in cash to the partners. Allocate the remaining balance in cash to the partners. So let's do a T account here for cash. So we say we had cash. Now, over here, we had initial $178,000 in cash. We know that's on the debit side. Then we sold land for $46,000. And then we paid our accounts payable for $20,000. So we take our $178,000 plus our $46,000 minus our $20,000. That gives us our $204,000. That's how much cash we have. Okay? All right, so now what we can do is now we can allocate that cash to the remaining partners, okay, based upon their capital balances. Okay, so we'll look over here in terms of our journal entry, and what we're going to do, give me a second because I'm going to flip the page over. Okay, so remember in step 3, what we're going to do is allocate the remaining cash to the partners. And so I wanted to draw out these T accounts here for you. So remember we had the initial Zahn capital balance of $70,000, and then we sold the land and we increased Kayla's capital by $2,000, so the balance is $2,000. Perez had the initial capital of $66,000, plus we sold the land and we increased his capital by $2,000, so the $68,000. Rashid, the $62,000, increased it by $2,000 from the sale of the land, $64,000. $72,000 plus $68,000 plus $64,000 equals $204,000, which is equal to how much cash we have on hand. So what we're going to do now in this step is to allocate this cash to the partners. And so that means we have to decrease their capital accounts. So we're going to decrease cash, and then we're going to decrease the balance in these capital accounts. So how do I decrease capital? With a debit. So I'm going to be debiting Zahn capital, debiting Perez capital, debit Rashid capital, and then credit cash to reflect that I'm allocating the remaining cash to those partners. The $204,000 is the remaining cash, so I'm going to do a journal entry to allocate that to them. Okay? So we'll come over here and we'll say, okay, Zahn capital, $72,000. Debit to Kazan Capital, $72,000. Debit to H. Perez Capital for $68,000. Debit to T. Rashid Capital for our $64,000. And then credit to cash for the $204,000. Okay? That would be our journal entry. Now, this is, of course, when we have a situation where there's no capital deficiency. Okay? That means all the owners have a credit balance, credit or zero balance in capital. Let's talk about the situation where there is a capital deficiency. Okay? Let's move on and talk about that. So that means that one partner has a debit balance. How can that happen? Lots of losses from liquidation, maybe excessive withdrawals, because remember when we withdraw, we debit capital and then we credit cash, okay? Or we debit withdrawals and then we credit cash, and then the withdrawals is added into the capital account. So withdrawals will eventually decrease capital, okay? Or we could have excessive losses from prior periods. And so when we have a partner with a capital deficiency, if possible, has to pay in cash to the partnership to cover that deficiency. So let's look at two situations. The first one is when the partner does pay up. They pay his or her deficiency, and then we'll look at the situations where the partner cannot pay the deficiency. Okay, so let's look at this first example. So look over here, and we say Zahn, Perez, and Rashid agreed to dissolve the partnership. Prior to the final distribution of cash, Zahn has capital balance of $19,000, Perez has $8,000, Rashid has the debit balance. This is the capital deficiency. Rashid owes the partnership $3,000, and then assume that Rashid is able to pay the $3,000. So when Rashid pays the $3,000, we debit cash for the $3,000, and then we credit T Rashid capital for our $3,000. Now, what's the balance in Rashid capital? It's zero, right? Because it is debit here. We credit it here. The balance is now zero. Okay? So now what we can do is just show the normal withdrawal of the cash, okay? Or the cash to the partners, just like we did in step 3 a few pages ago. Okay? So we will now come over here and debit Zon capital for the balance of 19,000, and then we will credit, debit here H Perez capital for the 8,000. And I got ahead of myself there. I was going to say credit to cash of the 27,000 right there. Okay. Okay, so let's look at the situation now where the partner cannot pay the deficiency. All right, so look at that example. Zon, Perez, and Rashid agree to dissolve their partnership prior to the final distribution of cash to the partners, which is step 3, member of the dissolving the partnership. Zon has capital balance of 19, Perez 8, Rashid the debit balance of 3,000. Rashid owes the partnership 3,000. And so, but we're assuming that Rashid is not able to pay. Okay, so in this case, the remaining partners with their credit balance absorb the partner's unpaid deficiency. Okay, according to their income sharing, and we're saying their income sharing and loss ratio, remember, is equal. So let's look at that situation. So the first thing that we have to do is decrease Zon and Perez's capital balance because of this right over here. Okay, so we're going to come over here and we're going to debit Zon capital for 1,500, and this journal entry right over here reflects this sentence. Okay, where they're going to absorb, or in this case decrease, their capital balances for Rashid's. Well, see, the problem is we can't close out Rashid's capital balance because it's got a debit balance. We can't close it out. So we have to credit Rashid's capital and then decrease Zon's and Perez's by a total of 3,000, and we split out that 3,000 according to their income and loss sharing ratio, which we're saying is equal. That's why they each get 1,500. So then we say H Perez capital 1,500, and then Rashid capital of 3,000. Okay, that's the first journal entry. Now the second journal entry is the distribution of cash and the closing out of the capital balances to the remaining partners, to Zon and to Perez. So now what we have to do is look at, well, what's their balance in capital? Well, it was 19,000 right over here for Kayla, and I just decreased it by 1,500. So the balance is 17,500. Same thing over here. H Perez, this 8,000, that's an $8,000 credit in capital for H Perez, and then I debited it for 1,500, which decreases it. Now it's worth 6,500. So I'm going to come over here. This is the step 3 journal entry to allocate the remaining cash to the remaining partners and then also close out their balances in capital. So I will debit Zon capital for the remaining balance in capital, which is 17,500. I debit H Perez capital 6,500, and then I credit the cash for the 24,000. And then I say right over here, note that Zon and Perez can attempt to collect that $3,000 from Rashid at a future date, and they do have a legal claim on Rashid's personal assets to collect that cash. Okay? Thanks so much. I'm going to end this lecture video now. Goodbye.